If you wanted to implement some hedging as one of the strategies within your overall portfolio, or maybe a portion of your portfolio, you wanted to hedge to protect against some losses, what does that look like? What are your options? I've got 4 major ways that you could be hedging some of your portfolio. I've got that and more coming up. Say the value of your house is $500,000 and it costs $2,000 a year to insure. That's a decent size asset, $500,000. And yeah, if something goes wrong, $2,000 out of your pocket for the insurance, for the coverage and peace of mind that if you have a loss, the house is going to be repaired. I mean, that seems like a good deal. That if something happens to the house, that asset, yeah, the $2,000 is really going to show up in a meaningful way. But if everything's fine, yeah, okay, yeah, you're out $2,000. Well, that's how home insurance works, and that's a fair analogy for how hedging works in your portfolio. I mean, your portfolio might be significantly bigger than that $500,000 house. And so oftentimes I talk about hedging and that maybe, depending on your situation, depending on your goals, you may want to hedge some of your portfolio. That helps as a diversifier, right? Because here's the thing, if you've just got a 60-40 portfolio and the 60 stocks go down, you're really crossing your fingers hoping that the 40, the bonds, end up doing okay and show up when you need them. They don't always do that. But if you're hedging, just like that home insurance analogy, listen, if the stocks go down, then those hedges show up. It's just contractually how they work. And so you may want to consider that depending on your situation, depending on your goals. And I often get asked 2 questions. One, can you go deeper? Like, I would love to hear more about what hedging strategies I should consider. You're a little vague. Well, I'm going to go deeper right now. But I also get asked, well, what sort of tickers? And I'm not going to talk about tickers. And I feel very strongly about this, and I'm going to tell you why. There's a lot of YouTubers that share, I mean, I see them as well, guys. I'm on YouTube and I look and I see people saying, if I could only own 3 stocks, here's 3 investments that you should hold for life. And they tell you tickers. And I think you should be very wary of anyone who does that. And I would be very cautious. And to me, it really is a black mark against them. And for a few very clear reasons. Number 1, videos on YouTube live forever. I don't know when you're going to be watching this. I don't know. And so if I tell you a ticker today that is fantastic, and then in 3 years, the mechanics of the fund change, the fees go up, the management changes, the entire structure changes, I don't know in 2029 or 2030 if that's still a good investment, and yet it's going to live in infamy on YouTube. That's distasteful. I wouldn't do that to you. Second, allocations matter a lot. And I haven't seen anyone on YouTube who's just throwing around tickers. Oh, if I could own 3 stocks or 3 ETFs for the rest of my life, I'd own these. They don't tell you what percentage. And just for an extreme example, if I were to tell you, oh yeah, the right barbell strategy would be NVIDIA and AGG, but I don't tell you, well, it's 99% AGG and 1% NVIDIA. That's a very different experience than if it's 99% NVIDIA and 1% AGG, right? So allocation matters. And oftentimes those, YouTubers that talk about tickers, they don't tell you the allocation because they can't. They don't know your age. They don't know your goals. They don't know your situation. And so they can't. And yet allocations, actually we've said and others have said that is the single biggest and most important financial decision of your life is what is your allocation. And then back to that, number 3, the third reason why I'm not going to throw around tickers and you should be cautious of anyone that does is oftentimes the tickers are, 3 or 4 all centered around the same category. The one I hear a lot is some ETF that tracks the S&P 500. Yep, there's 3 of them that are really good. 2 of the 3 have very low fees. The other one was the first and most popular. Yep, so one of those. And then a dividend, and then an all-world index. Well, guess what? Guess what the S&P 500 index ETF is invested in? S&P 500 index. And then the high dividend one is in the S&P 500 index. And then the all-cap world index. Yeah, about 60 to 70% is in large cap stocks. It's all almost the same thing. You're not diversified, and it's because diversification actually matters and it actually works. And they're not going to recommend or suggest some ETFs that maybe have underperformed recently compared to the S&P because I know everyone's anchored to the S&P. I'm going to get off my soapbox, but I'm not going to share tickers, and that's a little bit why. Now, how can you hedge? All right, let's do a deep dive. There's really 4 ways and maybe more than that, but these are the 4 primary ways. 1, you can use an active hedging ETF or mutual fund. And this is where you are, ETF or mutual fund, you are entrusting your dollars to a manager like a financial company, and they are going to actively manage hedging, meaning they are going to invest in an underlying index. So the S&P 500, very common one, NASDAQ, very common one, could be international, could be emerging markets, could be Bitcoin, could be some other sort of investment. And they're going to hold that asset, but they're also going to hold some hedging, but some stock options within that mutual fund or exchange traded fund, and either on a regular basis, so every quarter or every 6 months or whatever, or at the manager's discretion, they are going to buy and sell call options and put options to have some protections built in. So you don't know, well, how much upside will I experience? If the market goes up, am I going to experience 80% of the upside or 70% of the upside or 50% of the upside? You don't know. And then if the market goes down, how much protection do I have? You don't know that either, because it's all baked in and it's being actively managed by that management team, whether it's on a quarterly basis or on an ongoing basis. JP Morgan has some great funds here. A company called Aptus has some great funds here. There's a lot of good options out there for this, but you don't know the protection. You just are trusting the manager that they are buying and selling the right calls and puts so that you can participate in a lot of the upside, but also protect the downside. And so those are active hedging models. Those are very popular. We use them. Again, it's got to be the right scenario, and they're certainly not all the same. You're going to want to be very, very selective and careful working with your CFP. Second is an enhanced yield ETF. Typically, you don't see a lot of this in mutual funds, mostly in exchange traded funds, but this is very similar, where the management company and the manager are holding an underlying index or an underlying investment. So Bitcoin or gold or the NASDAQ or something like that, or the S&P 500. They're going to hold that, but then they're going to sell a smattering of call options or maybe even put options as well. They're going to sell those. And when they sell those options, that puts parameters on the performance of the underlying index, but it also means when they sell it, they get a return, they get a yield, they get that premium, and that's how they boost the yield. I've seen some that are extreme. 20% yields, 30% yields, just out of this world, right? And then there's some that are S&P 500 where the yield is 8%, where you'd say, oh my goodness, I can own the S&P 500 and get 8%, right? The puts and the calls are going to influence the experience. So you're not going to participate in the S&P 500 one-to-one, not even close, but you're going to get this enhanced yield. And you might say, I'm near retirement. I'm interested in yield. That's helpful to me. That's important to me. It's a way of hedging, because that yield is going to show up whether the underlying investment is going gangbusters or it's going down. You're going to get that yield. So second way to hedge is an enhanced yield. Not that you're investing in dividend stocks, although maybe, but you are investing in an underlying index that is also selling options that is creating a yield that gets passed on to you, the shareholder. By far, the most common, this space has exploded in the past 2 years. The third way to hedge is I'm going to call defined outcome. Okay, some of you might know it as buffers. I don't like that term personally. We started hearing about these, exploring them in 2019. No one had heard of them. We got an early take on it. Very interesting. Then 2020 happened. I do not want to cap my upside in 2020. After that 2020 surge and stocks got very, very expensive on a relative basis, we've started using them, and we've been using them ever since. But when the situation is right, and this is where I think it's very dangerous, because a lot of people are using them thinking one thing, and what actually happens is they're really cutting the top off their investment experience. So this isn't for everyone. It really depends on your situation, but a defined outcome exchange traded fund or mutual fund is one where you are holding, again, let's call it an exchange traded fund that tracks an underlying index, but it also owns collars. So a option strategy, calls and puts, where the upside experience over the next year or 2 years or 6 months or whatever is defined within that exchange traded fund, it's capped. If the market goes up, you're going to go up, but capped at 8% or capped at 7% or capped at 11% or 12%, whatever. You're going to be capped. But if the market goes down over that year, you're going to protect against the first 15% decline or 18% decline, or you'll experience the first 5% but avoid the next 30. Some of them say you won't experience any decline of these except for the management cost. And so a lot of different options, a lot of different variations there. And so, but be careful. These make a ton of sense in the right circumstance. They make no sense in the wrong circumstance. Right. So, and there's a lot of options out there. Tons of money has flooded into these over the past couple of years. People like them. I get it. It's defined outcome. It's a clear experience. Use them for the right reasons and use the right ones. Okay. There's only a few out there that I would recommend. And there's way more than that available. And then lastly, the one that we really, really love, this is an option overlay. This is where you actually own the underlying investment. You're not entrusting it to a manager. You own the underlying investment, and then you own the call options or the put options. You own the stock options. Say you own the S&P 500. Say you own some individual stocks that have really run up in value, and you're looking at this value and you're saying, that's the $500,000 house. Oh my goodness, if that value crashes, if this is, I just did a video about max drawdowns in the past 10 years of some of the biggest stocks. And so if that happens, oh my goodness, I'd be weak in the knees. I'd throw up, I think is what I said in the video. And I want to protect some of that. I'm willing to give up some upside in order to protect some of that. That's where you work with the professional and you buy some call options on that asset that you own. So you're not entrusting it to someone else. You own the asset, and then you're also owning the stock options. You're going to want to work with a professional. This is an options overlay type strategy. Say you still want to own the stock. Maybe you want to get some yield on the stock. You want to protect your downside. Maybe you want to start selling it, but you want to sell it at certain prices, and you're willing to sell some calls in order to get some additional premium for that. There's a lot of strategies. Work with a professional. That's another way to hedge. All of that, though, depends on your specific situation. I like your goals, how much money you have, what age you are, what you're hoping those dollars will do for you. All of that depends on your unique financial situation. Your investment strategy needs to be appropriate for your unique financial situation and all 6 areas of your financial life. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. Out there you have it. Go out and take your next wise step in your financial life.